and how we delivered the initial start of this on Friday evening. Did that work for you? Did you benefit from it?
Yes, yeah, yeah, I was happy with the approach. Yeah, I made notes on my side as well, so I did get something out of it.
Awesome.
Yeah.
Did um did the notes that I provided you make sense? And does that help?
To be honest, I haven't gone through them.
Hmm.
Yeah, I haven't gone through them, but
Which is fine. This is perfectly fine because you made your own notes as well. So that's great. But what I'm going to do anyway, because is that after every session, I try and provide that to
but
you.
but if I browse through quickly, because I'm just comparing to what I wrote while you
Mhm.
were going through the session. No, they make sense. They make
Okay.
sense, David. Yeah.
Yeah. So the idea really is that you walk out from the session with some form of summary. All right.
Okay. No, this makes sense. This
All
makes
right,
sense.
that kind of supports you. You can print them out, all right? You can keep it, all right? And if you need to refer back to it, you can refer back to it, all right? And that's really what I want to try and do if with every session. Because then, the recordings are available for you, but to go listen to an hour and a half recording
It's
again
time
for
consuming.
it's we don't have the time for that, all right? And so that's the reason why, unless you really feel, okay, that particular recording I really want to go back to, but you can't go back to every recording. All right. There's just no time for that. So let's then jump into it then. And I think I'm going to jump into it by, let me just do this quickly. Um, there,
It's cold.
there, there. Okay, maybe I'm going to jump into it by just, browsing through some of the notes. I'm going to share my screen um, because it's going to be important that we just kind of consolidate where we were and so we move on from there. All right. So
Okay.
essentially, I'm not going to read through everything. I'm just going to pick out certain things as we go through it. All right. But
Okay.
essentially, we spoke about risk. All right. And we spoke about risk being positives and negatives to that risk. All right. We spoke about risk being actually the expected outcome differing from the actual outcome. All right. And then we spoke about derivatives and what a derivative really is, trying to kind of simplify it, all right, to show that the derivative is really something that you use to mitigate your risk so that you close that gap between the expected outcome and the actual outcome.
Mm.
All right. We said you can, in terms of risks, it can lead to both opportunities and threats. And that's where I kind of just aligned that. So we didn't want to look at things in isolation. Remember, we want to say, how does this link to key business strategies? How does this link to the models that we use, like SWOT, etc., and kind of make that link. Then we spoke about risk management, which really was risk management was just to reduce the volatility and manage that uncertainty. And risk management really is what you do to make sure that you kind of uh, um, make the highs normal and make the lows normal. All right. So bring the highs and the very highs and the very lows into an acceptable range. All right. Of
Mm.
predictability, really. And then we just did the introduction in terms of the derivatives, all right, that we really want to hedge that risk. We spoke about a few common examples and options and forward exchange rates, and we spoke about gold.
Mm.
All right. And then we also looked at the different kinds of risk. All right. We looked at currency risk, and we looked at interest rate risk, inflation risk, equity price. There's things like credit risk as well. I'm sure you're quite familiar with that.
Mm.
There's financial risk. All right. So there's all of these kind of risks, and I'm one of the reasons why I thought to do this kind of introduction is because as we go into this now, we're going to go into kind of a little bit deeper into that, but then also end up with some examples, all right, in terms of how does the questions get asked, all right, in a, and then also I have a test slash exam question of how they structured it, or how
Oh,
the question was asked. Because remember, part of what I want to do is not just take you through the content, but part of what I want to do is really connect the content to examinability.
yes.
All right. And kind of match that so you can see, oh, this is how the content matches our question gets answered, all right, and what the link is between some of the things that I may have emphasized in an example or
Yes.
a question, all right. So that was the different risks. And then we, of course, spoke about the option. Remember, we spoke about the call option, the put option, and the call was to call your supplier, and the putting was actually to make the offer. That's really what it was. And then we spoke about benefits of risk management, and why we want to do risk management. Remember, we spoke also about this around the exams and evaluating your financial decision, defining an interest rate swap, explaining its purpose and questions. But we're going to get into that a little bit more detail now. We also then spoke about the reason why we were approaching it from the way that we did was because we want you to have a bedded a conceptual understanding, all right? So that you're not relying on memory, and so that when things come from different angles, that you were possibly not prepared for, because your understanding is grounded, you are able to at least attempt the question and at least pass the question, all right? So that's really what the aim was as well. All right. And yeah, that was really it. All right. So today, all right, there's really three fundamental derivative options. All right. The three options are three fundamental derivative instruments, and the three of the instruments are really your options, your forward contracts, and your futures. Generally, there is also swaps, all right, but swaps can actually fit in with options, all right. So that's why we kind of just define those three. And really, what we want to go through in this beginning is really just highlight those three, all right, and then also kind of tap into the valuation of it from a really broad understanding and a simplified understanding. All right, that's really what we want to do. All right, we already spoke in the previous session. We spoke about some of the definitions, which was call option, put option. I'm not sure whether we spoke about the exercise price or the strike price, but really, if you look at an option, and maybe that's the first one we want to discuss amongst the three, all right? An option really is, like we said, it's the contractual, contract to purchase and under purchase or sell an underlying asset at a predetermined price in the future. That predetermined price in the future is the strike price. All right. So if I make an example, if you've got an option to purchase a share, all right, in Aspen, you've got an option to purchase a share in Aspen in 12 months' time. All right. Typically some of the ways they do that is through employee share schemes, as an example. They issue
Mm.
employees options. Then what happens is they'll give the option to you at a predetermined price, let's say of 10 Rand. All right. That 10 Rand is the strike price. The strike price or the exercise price is what you will pay for the share at that particular
That's what.
date in the future. All right. Now, this is where it becomes a derivative, because that option and that strike price has nothing to do with the actual share or the actual underlying asset. Right?
Mm.
That underlying asset, in this case, an Aspen Pharmacare share, all right. And I'm sure it trades on the JSE. I'm not too sure. But let's say it's trading on the JSE, all right. That value of the share has got nothing to do with the share, with the strike price,
Mm.
all right. In other words, it's independently valued by virtue of you're right, the market, etc. Right, supply and demand, and all of those kind of things. All right, so what happens is that share. All right, here's another terminology that you need to become familiar with. That share has an intrinsic value. All right, that intrinsic value of the share is actually what the share trades at on the share on the stock exchange. So let's say that share, what did I say? Your option is for 10 rand or 15 rand. What did I say?
10.
10. Okay, so you've got an option to purchase it for 10 rand. All right. Let's say that it's trading on the stock exchange for 20 rand at the time that you are able to exercise the option. All right.
Yes.
What this really means is that, right, you are able to buy something for 10 rand that is worth 20 rand.
Mm.
All right. So what then happens is there's then a difference between the strike price and the market price, all right, or the intrinsic value of the share. All right. And that difference, all right, is really the value of your option.
So is the intrinsic value the same as the market value?
No, sorry. No, let me explain it to you. The intrinsic value of the option. So
Okay.
the first thing I was talking about was the intrinsic value of the share, but the
Okay.
intrinsic value of the option, which is the part that I'm talking about now, is a difference between the value of the share and
The
the
market.
strike price,
Oh, okay.
right? Because remember, the market price of the share is what's on the JSE.
Yes.
The strike price is what the company gave it to you for, gave the option to you for.
Okay.
Does it make sense? Let me use
Yes.
the example again, all right, just for clarity. The company issues you an option for 10 rand share. What that says is that you are able to purchase a share for 10 rand. That is the strike price or the exercise price, what you will be able to purchase the share for. The share trades independently, and the share's got let me not use the word intrinsic value. The share's got a market value of 20 rand at the date when you are able to exercise that. All right.
Yes.
That means that you made a profit. Does that make sense?
Yes.
You made a profit of 10 rand on every option that you exercise. All
Okay.
right. That 10 rand profit is the intrinsic value of the option.
Perfect. Makes sense.
Does that make sense? All right.
Yes.
Now, in this case, you made a profit. All right. This is when you make a profit. Remember, it's an option, like we said the other day. You have a choice to exercise it or not. All right. And you are only going to exercise that option when it benefits you.
Yes.
Make sense? All right.
Yeah.
If it doesn't benefit you, you're not going to exercise it and you lose nothing. All right. So when it benefits you, it's what they call in the money.
Okay.
Uh, that's what in the money is. When it doesn't benefit you, it's what they call out of the money.
Okay.
Right. So now there's also a thing like deeply in the money and deeply out of the money. And the only difference is that the benefit that you're receiving through that option is significant. All right. And that's really what deeply in the money is. For instance, in this case, making a 10 rand profit is making 100% profit. That's deeply in the money. If you made a 10% or 20% profit, then it would just be in the money.
Okay.
All right. Does that make sense?
Yes.
All right. And that's really how the option works as an underlying derivative, all right, to exercise at a date in the future. Now, I use an example now where it didn't cost you anything. The company issued you by virtue of you being a manager, by virtue of an incentive scheme, they issued you those options. All right.
Mm.
So when they issued that options, it didn't cost you anything.
Yes.
All right. But generally, an option can be purchased.
Mm.
In other words, you saying, I want to purchase this option, all right? And there's a cost associated with purchasing the option, all right? And that is called a premium. So I'm purchasing that option for a premium. It becomes then the cost of that option, all right? Which means then my intrinsic value, all right, which is the difference between the strike price and the market price of
True.
that, all right, is now reduced by that cost,
Mm.
right? And then, of course, that also determines whether I'm going to exercise that option or not, right? Because if I factor in my cost of the acquisition of that option now, all right, I might then not, it might not be then to my benefit to exercise that option at that point in time.
Mm. Okay.
Does that make sense?
Yeah, it makes perfect sense.
All right. Now there are also times for options where they will particularly maybe with employment share schemes where they will issue an option, all right, where the option strike price, all right, is higher than the current share price.
Mm.
So as an example, if I flip the example that I just used now, all right,
Yeah.
the share is trading at 10 Rand today, and they give you an option to purchase the share at 20 Rand. Now, if you do that today, all right, is it to your benefit to exercise
No.
that option? It's not. And simply put, it's not to your benefit because you can just go to the JSE and buy the share for 10 Rand.
Yeah.
All right. But all right, this is where you the intrinsic value becomes a time value. All right, because all right, it might not mean anything to you right now. All right, but if you look over 3 years as an example, all right, the Aspen farmer care share would go from 10 Rand, let's say, to 50 Rand,
Mm.
and you then possess a option to purchase for 20 Rand. Can you see that over time, all right, something that was not valuable for you at the time when you bought the option became valuable as the share price increased?
Mm.
So, so, so there's those two options, all right, where at the time your option is less, all right, therefore it already has an intrinsic value,
Mm.
or there's a time value element, all right, which means that you can benefit by holding it over time and taking advantage of a strike price where you have the right to purchase it when the share price has significantly increased.
Okay. I
Good,
get you.
good. So let's move on to then let me see my notes here quickly. Let's move on to futures and forward contracts. All right. So futures and forward contracts are generally the same thing, and they could be considered the same thing. All right. The difference between a future from a forward exchange contract or forward contract is that it's usually a future is linked to an underlying commodity. That's really what it is. All right. So futures would be linked to, for instance, wheat and maize and oil maybe, or those kind of fuel commodities, whereas a forward exchange contract might just be for a determined event. All right, what I want to do at a specific point in time to purchase I need foreign exchange to purchase at a future date, as an example.
Yes.
All right, so that's really the difference. Now, um, uh, I think it's best maybe to look at this as an example. All right, and the example is that um, you have if I was going to buy maize today, let's use maize, all right, and it cost me 100 Rand a ton, all right, then what would happen is I would have to take out my 100 Rand today and buy it today and take delivery of the maize today. Or alternatively, if I'm going to buy an asset in the future, I'll have to take 100 Rand today, all right? Pay for the asset and take delivery of that asset, all right? So if I take delivery of an asset today, all right, that means I can benefit from that asset, and the economic benefits from that asset can flow to me immediately from the day that I take delivery of that asset. All right.
Yes.
Now, this is the principle. I almost want to call it the opportunity principle, opportunity cost principle, all right, that you need to understand when it comes to forwards and futures, because essentially, if I then remember, and also the overriding principle is about mitigating risk. It's about bringing certainty. All right. So if I now right know that I can't take delivery of the asset today, all right, at 100 Rand, I have to order it. All right, and the asset is going to be imported, let's say from the US. All right, so there's going to be dollars. All right. I'm losing certainty. I'm losing certainty. Things are becoming uncertain because the supplier can only deliver it in 12 months' time. All right. So what I do is, all right, I now say, okay, the supplier can only deliver it in 12 months' time. And because the supplier can only deliver it in 12 months' time, all right, I need to buy certainty. All right. So what do? I purchase a forward exchange contract, all right, for 150 Rand. Right? Let me just look at this example quickly. Yeah, I purchased it for 150 Rand, all right? So what happens is I purchase it for 150 Rand today, all right? And I then say, I now know for certain that I will have 150 Rand in 12 months' time. Does that make sense? All right. So what then happens is,
I love that explanation.
regardless of what happens in the future, regardless of the exchange rate, regardless of everything, today I know that I will have that amount of money to purchase the asset. All right. Now, here's the difference between the example where I said purchasing the asset today and purchasing the asset in the future. If I purchase the asset today, there's a cash flow implication.
Yes.
Right? If I purchase the asset in the future, there's no cash flow implication. Right? You understand that? Right? Which means the money that I was going to spend today, all right? The money that I was going to spend, just hold for me. Madison, please put the dogs out. The money that I was going to spend today, all right? It's still in my possession. Right? So what I can do then is I can invest that money today. All right. And let's say I get a 10% return on my investment. By the end of 12 months, I would have 110 Rand in my bank account. Does that make sense? Now, you know the time value of money, isn't it? Hey, Tobili, can you hear me now?
Yes, I can. Sorry about that. I'm not sure if it was on my side or your side.
I don't know. Okay, well, you can hear me now. Do you want when we go back to that explanation, just circle back to that
Yes,
explanation?
yes. I lost you when you were still explaining about buying the purchase, purchasing the assets today versus when you have an FEC in place.
Okay, fine. So let's just so that we're on the same page, let's go back. All right. If I purchase the asset today, that means there's a cash outflow today.
Mm,
All right. And like I said, which means you can then derive economic benefits from that asset immediately. All right. If I don't purchase the asset today, all right, I know, and I'm expecting that in future it's going to cost me 150 rand. 12 months down the line, it's going to cost me 150 rand. All right. So what I then do is to buy my certainty, all right, because I was expecting to have a cash flow of 100 rand today, all right, for it. If I don't buy my certainty, then it means my cost of purchasing the assets basically increased by 50% in 12 months time,
mm,
right? And this is where the risk management strategies come in and say, no, I want to know I want the certainty of that asset today, right? Because I know I'm going to buy it in future. So what I do is I take out a forward exchange contract today, all right? And I then, all right, remember forward exchange contract, there's no cash flow,
mm.
all right? It is just the
Commitment.
promise or the commitment, the obligation to do it in the future, all right? So what then happens is I can pay 100 rand today for 150 rand in the future.
Mm.
That's really what the forward exchange contract does. So what I do is instead of having my cash flow, all right, out to purchase the asset, I then keep that cash flow and therefore I can earn, I can put it in the bank account and earn 10 rand interest. Does that make sense?
Yes.
Right. Now what happens in the future, right? I've got this contract to for the for the 150 rand. Essentially, all right, the 110 rand that I now have in cash, all right, right, versus my ability, all right, to use 100 rand to buy 150, that becomes my profit, if I can call it that. I'm not sure if
Mm.
that makes sense. Because
Yes, it does.
I can sell that forward exchange contract for 150 rand. Because at the day, 12 months later, it's worth 150.
Yes. Mm.
And I only paid 100 rand for it. Right?
Okay.
But, all right, the actual true profit is, remember, there's a premium associated with it. And let's say, all right, it was 100 rand, but to get the forward exchange contract, it cost me 10 rand.
Mm-hmm.
So the 100 rand cash outflow plus the 10 rand, let's call it a brokerage fee or whatever it might be, all right, minus what I can sell it for, that becomes, they call that an arbitrage profit,
Okay.
all right? So I know it's a lot of like, what does this mean? What does that mean? And how does this fit in together? And all of those kind of, the whole idea behind what I'm trying to do here is not necessarily to dump dump concepts on you, but to build frameworks, to build understanding, so that when we get into the question, that understanding will now either will be there'll be an enlightening experience, there'll be reinforcement, and there'll be some increased understanding, if I can put it that way. All
Okay.
right.
Mhm.
Let's maybe talk about the futures as an example. All right. So the futures basically is really saying, hey, man, there's a lot of volatility in the market. All right. And let's talk about maize and speak about farmers as an example. All right. A farmer is planting now, it's is doing all the hard work, etc., and all of those kind of things. All right. And then and of course incurring expenses, labor, seed, utensils, tractors, fuel, all of the water, all of these things that he needs to do to be able to get a harvest at the end of the day. All right. Now, how bad is it, all right, to do all of this work, all right, only to find out that at the end of that, let's say, season, all right, you're selling your maize for a loss, right? So only because, I mean, let's say things happen and the supply is the supply, there's an oversupply, and because there's an oversupply, it drives down the price. All right. And because it drives down the price, you don't have an option and you have to sell it at that price. Now the farmer is saying, I can't do that. All right. There's too much volatility in the market. I want certainty that I will be able to sell my maize at X rand per ton. So that's where the futures come into play. So the farmer is guaranteed a certain price regardless of what the market price is at the time. And vice versa also, the person purchasing from the farmer can also mitigate their uncertainty, all right, by saying, I don't know what the up and down of the of the market price of the maize is going to be at that time. All right. I need the maize for, let's say I'm a manufacturer of cereal, all right, or I'm a manufacturer of bread, or all of those kind of things. All right. Think about some of the things that we were speaking about the other day about budgeting and costing and all of those kind of things. If I'm costing my bread at a certain price, all right, and suddenly there's a change in one of the key ingredients in producing that bread, what's going to happen is I'm going to either have to absorb that cost or pass that cost on to my customer. Now, if I pass that cost on to my customer, you might say, yeah, pass it on to the customer. But remember, I'm not the only bread supplier. There's Albany, there's Sasco, there's, all of these bread suppliers, all right? Now, if I'm not mitigating and putting in the risk management strategy and my competitor is, then what's going to happen is my competitor will be able to continue selling the bread at the same price. And for me, I'll have to raise my price. Guess what that does to my customers?
The price increases for them as well.
But what do my customers do?
They're
Are they going to
unable to pay?
Are they going to continue buying from me, or are they going to go to my competitor?
Definitely go to the competitors because they might be cheaper.
They will be cheaper because they put risk management strategies in place, all right, to keep their costs down, all right, to be able to have some certainty. That's what I'm looking for, certainty, all right? So can you see how it's not just about, oh, okay, I'm going to pass my cost on to my customer, even, right? So it's not my problem if prices increase in the future, all right? So I use this also as an example because I want you to see the connections with making these decisions, all right? That these decisions have far-reaching consequences more than just the actual option or the actual future. It goes to budgeting. It goes to market forces. It goes to competition. It goes to customers. It goes to cash flow. Can you understand what it goes that it eventually it reaches the profitability of the entity. All right. So this risk management strategies is not just a nice thing to do, if I can put it that way. All right. It's actually practical. Right. You probably do the same, all right, without you even knowing about it.
Yeah.
All right. Yeah. On a daily basis. All right.
Yeah, it's like
yeah, continue.
Yeah, it's like the session that we are having now. I did see the risk. I lost you there. Myself.
I lost you for the moment. You said you did?
No, I'm saying that like the session that we're having now, I did see the risk from far that, if I don't get help with Mac, they are, I would really suffer in the long
One,
run. I need to try and find ways to mitigate that risk,
yeah,
try to, just have that comfort when I go to an exam that I did my best and I utilized all the resources that I had in my disposal, something like that.
yeah. But let's continue with that example that you use. I like what you did there. Because remember, what I'm trying to do is create associations. And you did it so powerfully now. Because now you don't have to memorize this whole thing. All right? Because you're going to use the principles that you applied now for derivatives in this very example. The premium that you are paying is a premium that you pay to me.
Mm.
All right? And what you are doing is you're buying the certainty of the outcome, in this case, all right, which would be the success, and avoiding the risk of repaying 100K to, or whatever the cost is to UNISA.
Mm. Oh, well, yeah.
Yeah. Can you see? All right. So
Yeah.
you basically bought a derivative to
Yeah.
reduce the risk of that outcome. So essentially, remember what did you say?
Yeah.
The risk is the where the expected outcome is different from the actual outcome.
Mm.
And risk management strategies brings those two closer to each other.
Yeah.
Right? So you
Yeah.
basically put risk management strategies in place. And that's what I'm saying. These things we do on a daily basis. And what you did is you valued the price of what you need to pay for the risk management strategy. If for instance I charged you 20,000 rand,
Mm.
you would have said no. That that is not that is not the cost benefit doesn't make sense there. All right? Because that's almost equivalent to what I'm paying for the course.
Yeah, true.
Yeah, right. So essentially, you came to a part to say, what is this worth to me, and how much am I willing to pay, and what is the outcome that I'm trying to avoid?
Mm.
Awesome. I like that. Thank you very much for that. Cool. So let's go to um, oh, sorry, I was going the wrong way. I was wondering why my notes are not making sense here. Um, okay. That. Okay, cool. I think that's what I wanted to cover, because in terms of the quality, we did the options, we did the forward futures and the forwards. Let me just see quickly. Let me just see. Let me just see. Yeah, we did options, forward contracts, and futures. Those are the three primary instruments that I wanted to cover. All right, and now I want to go to an example. All right, and these examples are really going to it's going to yeah, you see now this is what happens. I had the examples. Let me just email it to myself. I had the examples on my other laptop.
Yeah.
um,
And then
let
it's
me.
here on my side, I need to buy a laptop because currently I'm using the work laptop, and this thing, I don't know, when I'm studying, it's just restarts itself more than 100 times a day.
Oh
But it doesn't do
no.
that when I'm at work. It's very strange.
Let me just give this a name quickly. Derivatives.
I
Derivatives.
already
examples.
Make a plan.
Okay, so that's it. Um, I actually forgot earlier that I was because I was I got up quite early just to make sure that I have all my notes and things together. And then I was working between laptops and I forgot to there's something in the chat. Can you see it? Some documents in the chat. No, you can't.
No.
You can't. Okay, fine. Because I sent it before you joined. That's probably why. But I'll resend it now. Okay,
Oh,
here we
okay.
go. Here we go. Let me just get it quickly. Here we go. Got it. Okay, I'm going to share my screen. Okay, fine. So this is first of all, I want to just let me increase it a little bit. Remember, we spoke about the different risk categories or different risk types. I'm going to send this to you so you don't have to take any notes here. All right.
Okay,
But
good.
so you can see, we spoke about strategic risk. All right. The risk of failing to achieve the organization's strategic objectives. All right.
Mhm.
Then we speak about operational business risks, risks that relate to the day-to-day operating activities of the company, poor internal control system, loss of key employees, product failure, etc. Then you have financial risk. This is risk associated with the level of debt in the business. So this is when you've got 80% debt and 20% equity as an example, right?
Mm.
Currency risk, I think we all know this, the risk of financial loss due to adverse movements in the foreign exchange rates. All right. This you'd be exposed to when, for instance, you are buying an asset from importing an asset. All right. Interest rate risk, all right. This is the risk of financial loss results from changes in interest rate. Remember, we spoke about the variable interest rate. And if the repo rate changes, right, the Reserve Bank governor changes the interest rate, it changes the prime rate. And when the prime rate changes, your interest rate with the bank changes. And so you're paying more interest, it becomes more expensive, etc. All right. Credit risk, this is risk of financial loss result of non-payment by debtors. I'm sure you know that as well. Then you
Yes.
have political risk. I think we know that very well as well, right? Economic risk. This is, inflation, unemployment, those kind of things. Just give me 1 second. I'll be done at 10. Right. Um, uh, um, um, so these are risks in the macroeconomic environment, all right?
Mm.
Information risk, I mean, there's many of them, all right? Information risk, technological risk, environmental risk, social risk, compliance risk, reputational risk.
Mm.
So again, I don't think you must try and memorize these different risks because in a scenario, the the scenario or the example, if I can call it like that, or what's actually happening in the scenario will help you, will be able to tell you to identify this as a social risk, is it a reputational risk? You know what I'm trying to say, all right?
Yes.
It's really you just saying, oh, these are all these kind of risks. Okay, if I get this kind of thing, it will mean this. I mean, technological risk, of course, they will have to tell you something about
Yes.
this, their IT systems or things like that, or whatever it might be. All right. So, or their systems are outdated, all right, etc. All right, those kind of things.
Yeah.
So,
And what
yeah.
I've picked up with Meg when it comes to discussion, risk discussion questions, you
Mm-hmm.
know, all the risk are in the question. You don't have to.
100%.
So
That's actually.
with most of their questions, you don't really have to scratch your head and try
Mm,
to figure out what to write, but it's a matter of being able to pick up those risks.
100%. to
those risks in the
identify them.
questionnaire.
Right.
Yes.
So again, remember when we were speaking in our in the session that we had, what was last week or week before, when we talking about the exam technique, we were saying that, right, you must have a framework, right, so that when you go to the scenario, all right, the scenario is not telling you things, you are expecting to see certain things. All right.
Mm.
So when you have this framework, so if you look at all of these risks, I mean, some of these risks are exactly what we have, for instance, under Pestel,
Mm.
political, economic, social, technological,
Mm.
right,
True.
legal. Can you see that?
Yeah.
All right. So when you then you must just remember some of the others which are not too difficult to remember, because credit risk, interest rates, these will all, you'll be able to pick them up from how the scenario is leading them. But instead of you now trying to, what are they saying here? No, I've got a framework, so I can say, oh, this is political, this is this is that. All right. So that's what you can do. All right. The part that you just mentioned now, which is very important, you spoke about, in the, that it's in the scenario. So the identification is important, but remember, you get the mark depending on what the required is going to say. But really, most of the time, you get the mark for not identifying the risk, but elaborating on the impact of the risk.
Mm.
All right. So, in other words, why is this a risk and how will it impact the business? So let me give you
Yes.
an or let me not give you an example now. You'll keep that in your mind so that as you go through the examples that we have, you'll be able to see what we mean by that. All right. So here the example is um, uh, Jupiter Limited. I don't think this is going to work now anyway, because it's a screenshot.
Oh, okay.
Jupiter Limited manufactures and sells computer equipment. All right. The company imports parts from China, and 80%, maybe what I should do is let me save this as a PDF, because then I can use a highlighter. Give me 1 second quickly. This is now like you're in your laptop.
Yeah.
Why must it do it now of all the times? It
Yeah.
was fine all along. um, and you know what happens is sometimes if you don't have documents saved, then you have a problem when you have to restart your laptop. Advanced PDF. It's taking a bit of time. I'm not sure why.
Yeah, it's fine.
Sure, don't know why it's taking so much time. Okay, let's continue. I'm not sure. Let's just continue like this with the document as is. Like, let's say it's just hanging. Okay, I'm sharing again. I'm just sharing my screen again.
Yeah, okay, that's fine.
Okay, here we go. Jupiter Limited. All right. So I want the reason I wanted to highlight it was just really to for you to maybe I can do this. Well done, David. Yeah, is for you just to highlight certain words. All right.
Mm.
Jupiter Limited manufactures and sells computer equipment. The company imports. Right. So already your alarm bells must go on.
Mm.
Right. Why must your alarm bells go on?
Because now if we are importing the parts, that means there's foreign exchange
So there's a currency
risk
risk.
involved. Yes.
100%. All right. Imported from China. Then 80%. All right. 80% is hectic, man. All right. And now, um, 80% is quite a big amount. All right. 80% of
Mm.
the sales are on credit. All right. Can you already see there? This is the problem, right? And
Mm.
because if anything happens, I'm stuffed.
Yeah, true.
All right. Then Jupiter has a significant amount of debt in their capital structure. That's also that's
That even
financial
makes
risk.
it worse.
Financial risk, all right, makes it worse. All right. So can you see, without even looking at the required, we already looked at certain keywords that kind of frames your mind on, not only what the risks are, but also what the impact of the risk are. Right. Now it says,
Mm.
describe the reasons why Jupiler is considered this a key risk factor. Now they give you credit risk and currency risk. All right. Now, generally on a PGDA level, they won't tell you this. All right. You should have
Yeah.
identified it from the scenario that there's a credit risk, there's a currency risk, and there's a financial risk. All right. But here, what they've done is, again, I say usually because sometimes just for bonus marks or whatever it might be, or they want to limit the amount of marks. So instead of giving you a mark for identifying, they also give you a mark for um, without giving you this framework, they also give you a mark then for identifying it. All right.
Mm.
So if you look here, like we said, all right, immediately you now finding yourself, all right, that okay, describe the reasons why. We already said, oh, credit risk, all right. Why is this? Why is the what is the impact of this credit risk? What's the impact of? All right, let
So
me ask, what is the credit risk? The credit risk is 80% of the sales are sold on credit, right? That's the risk. Why is it the risk and what is the impact?
so it's the risk because if customers do not pay on time, then the
100%.
company
Yeah, can't hear you now. Kabila, I can't hear you. Okay, there we go. You're back. I can hear you. Hello.
Oh, okay. Sorry. Yes, I can hear you.
Yeah, I couldn't hear for a moment. You were saying you were speaking about the impact. You said that if where's the thing now? Yeah, you said customers don't pay.
In payment of customers, then the company will not have enough cash inflow.
Yeah. So essentially what you're doing is you kind of saying, okay, you're seeing the repercussions, right? So, right, if 80% of my customers, that's a significant amount of credit, all right? If my customers don't pay me on time, all right, my inflows, cash inflows, of course, is not coming in timelessly, which means I can't pay my creditors, all right, which means it will impact my profitability. It means I might have bad debts, all right, because I have to write off the debts. Can you see that?
Yes.
All right, and then of course that's credit risk, and then of course currency risk, all right. Really that is about the risk that the currency against your currency will deteriorate, and this means that I will have to pay more, all right, for my parts. And if I pay more for my parts, it increases my costs, and if it increases my costs, it reduces my profitability. Can you see just the layered a step-by-step approach to be able to answer this kind of question?
Mm.
Make sense? So if I
Yes.
now go, all right, and here's the solution. All right, the solution says a significant portion of Jupiter's revenue is derived from credit sales. This first line is directly from the scenario.
Mm.
Right? So this, you're not going to get a mark for this, but this gives you the context to be able to get to the second part. This exposes the company to credit risk because if debtors do not settle their accounts, it could have a negative impact on profitability, increasing bad debts and liquidity of the business. That's exactly what you said, right? The next part here is the currency risk. Jupiter imports parts from China, which exposes the company to currency. If this rand deteriorates, the cost of the import parts will increase, and this could have a negative impact on the profitability of the business. Make sense?
Yes.
Awesome. Let's look at example 2, right? Penguin Limited manufactures swimming pool pumps, right? Parts are purchased from a single supplier in Pretoria. Penguin finances their day-to-day operations with a bank overdraft facilities, which bears interest at 3% above the prime lending rate. The company is investigating the purchase of a new manufacturing machine from a supplier in Germany. Right? Now you see what they've done here is they've not, in the first example, they gave you the risks. They said currency risk and credit risk. Here they're not telling you the risk, which means you need to identify them. And so what they've done here is they said identify and explain the risks and indicate. This is exam technique that's very important because you can already see there's 3 things that you need to do.
Mm.
All right? Identify, that's 1. Explain, that's 2. Indicate ways, that's 3. So you can decide how to write this. Do I write this in 3 columns? Or do I just write 1, 2, 3 below each other in 3 sentences? Does that make sense?
Yes.
So let's look at this, all right? What is this first line telling us? Penguin Limited manufactures swimming pool pumps. What kind of questions do you ask yourself here? So here's my question, right? It's my question would say, oh, they manufacture swimming pool pumps. Only swimming pool pumps? That might be my question. Are they specialists? Are they specializing? All right? Because swimming pool pumps is not the only thing that is needed for a swimming pool.
Yes, true.
Right? It's filters, it's plumbing pipes, it's tiles, it's all of these things that go along with the swimming pool. All right. So my question would be, remember we said we're identifying and explaining risks. So we're saying only swimming pool pumps? That may be a risk, right? Because you have one product, right? Then parts are purchased from a single supplier. Again, my question is, single supplier? Really? Right? What if that supplier goes out of business? What if that supplier
Overcharging them.
is overcharging you? What if that supplier can't deliver your demand? What if that supplier has a strike, employee strike? Can you see?
Yeah.
Right? Then they finance their day-to-day operations. Oh, you've got an overdraft facility that you use. In other words, you've got debt, and this debt has a floating interest rate or a variable interest rate. All right. This variable interest rate, all right, is remember we spoke about it earlier. It would be, you can either call it the interest rate risk, all right. It could also be a financial risk, basically, right? Because it's linked to your debt. But more specifically, there's an interest rate risk here. So can you see here, we've identified, all right, the risk here is that you're only selling one product line. The risk here is that you only have one supplier. The risk here is that you have a interest rate risk where you are linked to a variable interest rate, right? So you've identified the risks. If you go here further, is investigating the purchase of a new manufacturing from a supplier in Germany. All right. Again, here is possibly a technological risk. All right. I don't know. Again, I'm surmising when I'm going through this question. All right. They are investigating it. So I need to possibly look at technology there. All right. Because it's a new manufacturing machine. It could be, for instance, the risk of operating the new machine. All right.
Yes.
So think about those things, about what does this mean? All right. If it was me, all right, and I'm buying a new machine, manufacturing machine, can I use it? All right. I'm going to import it. What's going to cost me? All right. It's a supply in Germany. All right. There's a currency risk associated with it. All right. What's the lead time to receiving the machine? All right. What does that have? What's the impact on my current operations if I receive this machine, etc. All right. The thing with math, all right, is the information that you've been given, you must be able to kind of extrapolate it, right? To help you with your thinking through this, to be able to say, okay, fine, this is how I'm going to do whatever I'm going to do. And now when you come to the required, you can say, okay, fine, I need to identify the risk. So I've identified the risk. I need to explain the risk. One, one, one product. All right. Think about this. If you need to buy all your swimming pool equipment, or if you are in the manufacturing business of, or not manufacturing, in the building of swimming pools, would you go to buy the swimming pool pump, or do you go to a place that sells everything?
Most probably to a place that sells everything.
All right. Because you got purchasing power now, all right? Because you can tell him, I'm spending 100,000 Rand, all right, give me a 5% discount.
Yes, true.
All right. So if my risk is a single supplier, we already spoke about explaining that risk, all right? If they go out of business, etc. All right. Here the risk is, explain the risk is, what if the interest rate increases? Right? That's the risk there. Now, can you see here, indicate ways in which these risks could be mitigated? This here is risk management strategies, right?
Mm.
So this year you can expand your product range. This year you can get a second supplier. This year is now more the hedging kind of risk, because here you can either do an interest rate swap, or you can do a fixed rate of interest, etc. Make sense?
Yes.
Cool. Let's look at the answer. See what they've done. All right. They've split it into three columns. Limited product range. We got that. Penguin is solely dependent on the sale of swimming pool pumps. If demand for this product decreases, it could create a going concern problem. The mitigation, diversify the product range. What I want you to take note here is that we didn't say any different to this, but can you see how they've just put it in nice words?
Mm.
All right. All right. So what you need to do when you're going through these examples or whatever is kind of find ways to put things in a very clear, succinct manner, and pick up on how they put these things, all right, and make it become a habit.
Mm.
All right. Parts are purchased from a single supplier. We got that. Reliant on a single supplier. If the supplier does not deliver, we got that. You can go out of business, lost sales, right?
Mm.
Should source additional suppliers. We got that. Interest rate risks. Cash shortfalls are financed using a bank overdraft. It's linked to prime, which exposes to interest rate risks. If everything hedge the risk, can you see the interest rate future, interest rate option, interest rate swap? Can you see how the things that we spoke about leading to this is now
Mm.
coming into play here,
Yes.
right? Then machinery purchased from a supplier in Germany. This is currency fluctuations. And then you can take out a forward exchange rate or a currency option, money market hedge. All right. We're going into the last 15 minutes now. I've got this example, and I want to just show you the other one from an exam question. How are we? Okay, how is this going so far for you? Is it coming together?
Yes, it is. It is.
Right. Can I ask, how did you cover some of this content yourself before we started covering it? Or is this your first time kind of covering this information?
Well, I did browse through it.
Yeah.
Yeah, but not in depth. I just, yeah.
Okay. Just give me 1 second. All right, cool. So which is fine, because what I don't want to I don't want to be what's the word I'm looking for? We want to acknowledge we have limited time to do certain things. All right.
Yes.
So what I'm also trying to do at the same time is have some layer of depth in the tutor, all right, to make up for where you are unable to get through things,
Yeah. No, I'm
right?
I'm happy with this. And now I think after the two sessions that we've had relating to risk management,
Yeah.
uh, I'm comfortable to go back now and do questions on this.
Yes. Yeah.
Yeah. So
Yeah.
I'm
Yeah.
I'm 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 happy with our progress.
Okay. No,
But
that's good.
yeah, I think with Mac, when you're still doing the theory part, you feel like you're not going anywhere. But I look at it now, you just have to find a balance between the two.
100%.
Yeah,
100%.
so
Yeah.
I'm happy with this, and yeah, based on our discussion today and the other day, I am comfortable to go and practice questions, and then and then come back. We can discuss, where I feel I need more clarity on certain um questions that I've gone through.
Okay, awesome.
Yeah.
Awesome. Okay, so let me get you to read this example now,
Okay.
right? And
Uh,
you kind of tell me, all right, what you are picking up. Don't worry about the required now, but what are you reading in the scenario?
okay, so Struben Limited is a local supermarkets group listed uh within the retail sector of the JSE. So from the first line, we can see that the company is listed on the JSE and it's in the retail industry.
Remember we spoke about risks, all right? Risk can be positive or negative, all right? So
Yes,
is listed on the JSE a good thing or a bad thing?
it is a good thing.
Yeah, and why is it a good thing? What is the JSE used for?
I think it's used mainly for, to be honest, I don't know.
For capital raising, isn't it?
Okay.
The JSE is really because you are able to buy and sell shares on the public on in the public, right? If it's a private company, it's very difficult to raise capital, right? Whereas, for instance, on the JSE, you can just issue a prospectus and make shares available, and you can raise capital. But anybody can buy it, and so that's really that's the good thing about being on the listed. All right. Of course, there's negatives as well, all right, because you're exposed to the market, all right, where a private company is not. But that's the kind of thinking that I want you to kind of elaborate on. When I say elaborate, not necessarily now, but kind of think about those things, all right? Um, is a JSC a good thing or not? Right?
Mm.
Um, yeah, they said it's a supermarket group. Man, it might not even be applicable, but tell yourself, oh, they specifically telling me it's a supermarket group. What are the issues with supermarket groups? Is it good? Is it bad? Is it not? Whatever it might be, all right? All right, and how is this possibly related to other things? All right, supermarket group. All right, it's could be that the prices is very much linked to inflation, right? So there's that kind of macroeconomic risk as a result of being in the supermarket group. Within the retail sector, again, all right, retail sector, it's a specific sector. People, given the economy, people have less money, all right, so their purchasing power is less, all right, and because of that, competition might drive down prices, and of course competition is driving down prices. It might put you in a position where you are if you don't change that, you might either lose sales, or if you do that, your profit may be impacted. Can you see that?
Mm.
Right. Let's move on to the next paragraph.
Um, the company has undertaken an aggressive marketing strategy, which includes targeted promotional campaigns and the introduction of a loyalty program.
Okay. Again, I'm going to ask, what is it saying? So take out the keywords.
So they have
Aggressive.
undertaken an aggressive marketing strategy,
Just stop there
which,
quickly. Please
yeah,
stop right there. What does it? So firstly, you can do a marketing strategy, but here specifically aggressive.
aggressive.
What's your expectation when you do an aggressive marketing strategy?
Is to make sure that the company is known and then the return should reflect.
Yeah, but why do you, what is your intention to when you do marketing? What do you want to increase?
Sales.
There we go. Right? So now you can see here is that um um just give me one moment. Um, so now you can see actually here that if this aggressive market, this is the question I will ask. If this aggressive marketing strategy fails, what's going to happen?
There won't be any movement in sales.
Right? Which means you might, if you go back to the first thing that we were talking about, right? Competition, inflation, retail sector, all right? All of these kind of things that might reduce your revenue and it will reduce your profitability. It might put you out of business.
Okay.
All right. Can you see that? So I'm not gonna. I'm conscious of the time, but I wanted to just kind of highlight some of these things. All right. And now if you go to the required for each risk indicated below. Now what they've done here, can you see they've identified the risks, all right? So they've said these are the strong competition and failure to retain the staff. Then they say explain the current initiatives. This is saying these are the initiatives that we are undertaking. Explain those initiatives, all right, that will aid in mitigating these risks. You understand? Right? So again, uh I didn't give the I'll put the solution here and then I will share this with you. But I was rushing through this because I wanted to get to this here. You'll see I put it in the chat. So can you see this question from an exam?
Yes.
Recommend with reasons which hedging instrument mentioned by the investment banks would be most suitable to use in hedging the group's foreign currency risk. So basically, they said it's a currency risk. So what is the currency risk? Eh? Are you there?
Yes, I can hear you now. Sorry, I
Yeah.
lost you a bit.
Yeah, I'm asking what is currency risk?
Currency risk, that will be the foreign exchange.
In other words, the risk that your currency would deteriorate against another.
Okay, yes.
All right, that's really what the foreign currency risk is. All right, so you've identified they've told you the risk. Now they remember we spoke about derivatives, which is closing the gap between the expected outcome and the actual outcome. So what kind of hedging instruments? A hedging instrument is really what do I do to mitigate my risk? That's what the hedge does. All right, and we already know. All right, you can do the one thing that you definitely know is forward exchange contract. All right. So I'm not going to necessarily go into this now, but I wanted to just show you how this comes out here. All right. Now, if you look at the question, the first thing they said, recommend. In other words, when you close this, when you get to the end of this answer, you must actually come up with a recommendation. If you don't, you will lose a mark. And they say recommend with reasons. So I can already tell you that out of this 8 marks, there's 2 marks there. Can you see that?
Yes.
All right. Now, if I go back here, All right. This was the scenario. The scenario says there's a loan that is denominated in euro. All right. And while the loan will be facilitated by PH, the loan would be, etc. That's not. So there's a 400,000 euro loan with the term, interest rate, etc. All right. Now they say PH, who is responsible for the treasury function of the group, approach various investment banks. So if I go back to this, let me actually do this. I think it might be easier if I do it like this. Are you still good for time? I'm going to take another 5 minutes or so, if that's okay with you.
Yes, that's fine.
All right. I want to, so let me put it in there, and let me just insert this device. Okay. So you can still see my screen, right?
Yes.
All right. So can you see, all right, they said recommend with reason which hedging instruments mentioned by the investment banks would be most suitable. And here they're saying they approach various investment banks for advice. The advice they received from the investment banks was that it should hedge this by either a rolling 3-month forward exchange contract or an upfront currency swap. So I'm bringing in some exam technique here again. All right. Or they said recommend with reasons. That's 2 marks. The recommendation and the reason, which means you are left with 6 marks. Can you see that?
Yes.
And then they're giving you 2 options here. So there's already 3 marks per option. So basically, what you need to do here is really you need to explain what a 3-month rolling forward exchange contract is, what possibly an advantage is, what is good about it, maybe what's bad about it. So 1, explain what it is, define basically. 2, what's good about it, what's bad about it. That's 3 marks. Then the currency swap. What is a currency swap? What's good about it? What's bad about it? Then based on that, then provide a recommendation with reasons. So where did this thing, I want to close off by coming back to where we started with this thing. We were explaining what a derivative is. We explained what risk is. We spoke about risk management strategies. We spoke about how it is about narrowing the gap between the expected outcome and the actual outcome. All right. We
Yes.
spoke when we looked at this question. We spoke about currency risk, and currency risk is the risk that your currency will deteriorate deteriorate against the foreign currency, which means essentially you're going to pay more for something than what you expected to pay. All right. So really, this whole hedging thing is saying, how do I prevent myself from paying more for something? All right. And here are 2 options. And what is the difference between the 2 options? Right. So you need to know what these are. All right. So remember we said it's also about English. And remember we spoke about the forward exchange. That's the reason why I went through that earlier when we were speaking about forwards. All right. Remember one of the things when I said about forwards, I said there's no cash outflow.
Yes.
Remember that? All right, because that's what a forward exchange is. You're basically buying the certainty today of what you're going to pay for it pay in the future. Right? But there's no cash outflow for it. So there already you can understand, oh, that's what a foreign exchange is. That's the good thing about it. Now let's think about what the bad thing about it is. The bad thing about it is that now you are possibly committed to something that might actually turn against you. right? Because what if the exchange rate improves and now you are committed to buy it at that rate? Can you see?
Mm.
Right? Now here's the next one, a currency swap. Remember what we said? It's actually a swap, right? In other words, there's a physical exchange happening at that point in time. So automatically it's different to the first one, because the first one there was no physical currency exchange, right? There was no actual physical currency purchase. Whereas in this case, right, there's a cash outflow happening right now, right? Which means, right, there's a cash impact, a cash flow impact right now, right? And then also the opposite is true. What if the currency improves in the future? That means I actually spent more now than what I could have done it in the future. Can you see how we did that?
Mm.
Right. So I'm going to send this to you. And so if you look at the solution, all right, here's the solution. The solution says currency swaps. Currency swaps involves two parties, all right, who exchange principal amounts of different currencies, pay each other's interest, etc. They essentially swap the exposure risk with another party. Da, 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 da. All right. Um, Then, yeah, FECs. FECs are derivative contracts to buy or sell at a future date. There's a commitment to buy at a certain date, and they have to honor this whether it is favorable to them at the future date or not. Remember, that's exactly what we said now. All right.
Mm.
Then a rolling strategy implies that the 3-month forecast will be entered continuously over the 5-year. All right. There's no upfront costs, all right, etc. All right. Then, if you look at the recommendation, a currency swap is a far more effective long-term hedging strategy, as the principal amount of the loan is effective convert at the current date. And this is important because the scenario here told you that this is going to be over 5 years, right? So you're also looking at what is is my hedging. All right. Remember, we also spoke about the other day about your derivative must match your term, right?
Yes.
And the risk. Remember when we spoke about the gold.
Yes.
You don't want to invest in gold to cover interest rate risk over the next month. All right. So that strategy, the risk management strategy that you're putting in place must match that. All right. So I just wanted to highlight that. I'm going to, of course, share this with you so that you can actually look at the detail.
Oh, okay. Thank you.
Does that make sense?
Yes, it does. Thanks.
All right. Did you benefit?
Yeah, of course I did.
All right. What just before we wrap up, what is one takeout for you here in the session today? One key takeout for you.
Well, for me is one to make sure that every information that is given I am able to expand on it, why is this given and what impact,
Mm-hmm.
like general, without even looking at what's the question specifically wants, if they mention a specific industry, just have like an idea of what's happening in that industry and what are the risks
Okay.
involved. Yeah.
Okay. So for me, if I must encourage you with certain things, all right, broadly speaking now, I would encourage you to ask more why.
Okay.
Right? Why is this like this? What are the implications? What if they do it differently? Why are they giving this information? What is the sentence saying? Right? You remember that extrapolation that I was asking about, right?
Yes.
All right. So that for me would be saying, hey, take this step. All right.
Okay.
But tip is underpinned by things that you just also said at the beginning, which was associating the understanding with what you are doing. Right?
Mm-mm.
Remember how we said, how you put risk management strategy in place in your own life,
Yes.
right? And making those links, because then now there's a deeper understanding of it, which means even if a question comes that is maybe something that you don't understand technically, right? You can wing your way around it because you've got the understanding.
Okay.
Awesome. I'm going to share this with you. Maybe just during the course of the morning. I just want to fix up that copy and paste stuff that I did. I'll share with you the summary notes as well. And then we'll see each other at 8 o'clock.
Okay. Thank you. I think
All right.
I'll also go through this today. And yeah.
Awesome.
Thank you. Enjoy the rest of your day. We'll see you later.
Cool. Thanks. See you then. Bye.
Thanks.